Killol Pandya, Senior Fund Manager, Debt at LIC Nomura Mutual Fund, who now joins in on the show. Killol, great to have you with us, and take us through your views on how the bond yields are likely to pan out, because you do have some voices who say that it could touch a level of 9.25%, but the uncertainty is going to continue till the new government is formed. Your views?
I am not so sure that it's going to reach 925 in a hurry. But yes, I entirely subscribe to the sense that the volatility and the uncertainty are here to stay. In fact, I had mentioned it the previous time I was here. There are two major themes which we face in the bond markets today. One is, of course, the elections, which bring with them a host of political as well as economic uncertainties. And then we have the monsoons, with the central bank increasingly focusing on CPI, which is food heavy, which in turn is significantly dependent on the monsoons. We have yet another factor which is notoriously unpredictable, and it's basically a game of wait and watch as far as the monsoons are concerned. And a similar approach by necessity has to be adopted with respect to the elections as well. So these are basically watershed events, and we are not really able to see past them. The way in which these two events will pan out, each of them jointly and severally, will set course for how the economy is going to perform in the coming quarters. So definitely a lot of anxiety and tentativeness has crept into the markets, which I don't think is going to evaporate in a hurry. The next couple of months promise to be quite anxious as far as bond traders are concerned. In this light, as far as a bond trader is concerned, it is difficult to find gumption to build positions, and that has led to a kind of a risk-off approach, as it were, which periodically is tempered with trading bouts, which is why we tend to see the spikes and dips. However, if you see across a larger time frame, the bond yields have been pretty much range bound. They are not actually moving anywhere in a hurry. This trend of seeing spikes and dips, some of them event driven, some of them expectation driven, seems to be the new normal, at least in the short term.
IMF growth projections for India seem fairly upbeat, and perhaps some would say that that's what fueled the rally yesterday in the equity markets. 5.4% for FY14, 6.4% for FY15. What is your stance on these projections?
To be honest, not really able to see so far into the future, especially in the context of the factor which I just mentioned to you regarding the elections. Our best hope is that we get a strong central government. It does, from that perspective, it doesn't really matter which party. Of course, the markets are appear to be strongly, siding with one of the two factions. But from the apolitical sense, a strong center will do us well. However, if India does end up giving a fractured mandate, then it will lead to a fresh set of troubles, in the sense that it will lead to a lot of anxiety amongst domestic players as well as international players, and that will have ramifications on the flows as well. So in that context, the IMF projections regarding the next year are not something which bond traders can afford to focus on right now. As far as near targets are concerned, they seem to be pretty much in line with what the RBI's own projections are. Of course, again, I would like to refer to RBI's own policy statement, wherein it has mentioned that depending on how the monsoons pan out and how the elections pan out, our economic recovery may get kind of delayed, or the U-shaped recovery, the throw can get prolonged. Those are the dangers which we are facing. So as far as the IMF projections are concerned, the near term seems to be in line, and as a bond trader, I really can't afford to focus on the next year's target as of now.
But I'm just wondering, Killol, a lot of people believe that this 9.1, 9.2 levels, the yields, are really attractive level for investors to park their money into bond funds. What would you believe could be the case if somebody has a 1 year, 1.5 year perspective?
Historically, the 10-year has not lingered above 9% for a very long time. That is in part, giving the foundation to the conviction that it's really a good time to get into the bonds. And yes, from a retail perspective or from a non-trading perspective, if one has sticky money which one can afford to park in for say 3 quarters or a year, then it pretty much might be a good time to invest in pulses, into govies or even attractive corporate bonds. Given that time frame, say a year, that is 3 quarters or 4 or 5 quarters going ahead, it is quite possible that there is money to be made by investing right now. So yeah, I would give in to that, provided one does not have the trading impulse or compulsion.
A quick estimate as to where you see the IIP and CPI figures settling at?
Again, CPI especially is completely linked to how the monsoons are going to pan out. So with a medium-term context, say 3 or 4 quarters down the line, it's difficult to predict where the CPI will settle because we'll have monsoon implications coming in then. However, for the coming 2 months, I believe CPI should trend lower. In a similar vein, WPI too might trend lower. But if monsoons do prove to be deficient, we'll have to see how much deficient they are. In that context, CPI might start spiking up, say 2 quarters down the line, which is something we'll have to watch out for.